Hello, everyone, and welcome to Interactive Brokers Podcast, IBKR. I'm Jose Torres, your senior economist. In today's episode, we're going to be chatting with Lincoln Archibald. Lincoln is the managing partner of Fund Launch Partners, a private equity firm specializing in GP stakes. He is currently a minority partner on multiple funds across the alternative landscape. Lincoln is partner at Fund Launch and formerly functioned as the CFO. With prior experience from JP Morgan, venture capital, and real estate development, he brings a strong analytical and financial background to his work. Functioning as a fund consultant, Lincoln has coached and advised hundreds of emerging asset managers over the past few years across the alternatives landscape: venture capital, private equity, real estate, hedge funds. Finally, Lincoln has been able to observe the intricacies of sound fund management and truly learn what is required to be a successful steward of investor capital. Lincoln, welcome to the program. It's great to see you here.
Hey, thank you. Great to be here with you guys.
Terrific. Yeah. So, what got you into this business? Here at Interactive Brokers, we service a lot of those customers that would be your customers, also use us as prime broker and for other reasons as well. Well, what got you into this space?
I'd had different exposure to different parts of the alternatives. And then about 5 years ago, me and my partner were looking out to start our own fund. And his dad is the co founder of Bridge Investment Group, which is a $50 billion real estate family of funds. We were just asking him questions every day about how to start a fund. How does this work? What's a 506B versus a 506C? How does this Reg D filing? What should we have in our data room? Just all the questions that there's not really anything on the internet about. So we kind of took it upon ourselves as we were kicking off our own funds to say, hey, look, let's codify this information and put together an educational product on supporting emerging managers. And it kind of took off. So we incubate almost over 100 funds a year now. It kind of started as education, quickly turned into an incubator of sorts. But yeah, we incubate just over about 100 funds a year. And we just kind of followed the needs of our clients as they asked, who should I go get audits with? Who should I do compliance with? Who should my prime broker be? How should I pay my partners or advisors, or just all the questions of fund management? And it kind of led us to then launching a GP stakes fund where we now partner and invest with emerging fund managers.
So, with stock valuations extremely lofty here at 22 times forward earnings, if you look at the S&P at 5,500 and $250 of earnings per share expected in the next 12 months, and bond yields not earning as much in excess of inflation, a lot of folks have looked into the alternative space to earn excess returns, call it those 10 to 20% returns, whether that's hedge funds or private credit, or for the more growthy types, venture capital. Out of those 100 funds per year that you're bringing on, what's the distribution, you would say, across different kind of fund types?
Yeah, about 42% are real estate related strategies, about 25% are equity venture capital related strategies, and about 25% hedged. And then we always get some subsets of private credit or very unique true alternatives strategies that may not have a bucket. But I love what you said there. An interesting data point in 1950, about 6.5 million Americans owned US stock. By 1990, 65 million Americans owned US stock. And then by and today, almost over 150 million Americans owned US stocks. So we've seen this mass adoption of just investors on the stock market in general, right? And we're kind of starting to see the same adoption rate in alternatives, where more and more retail investors are wanting access to alternative investments. And it kind of gives the perfect place for an emerging manager to come in and take on retail investor capital to start to grow your portfolio, grow your AUM until you're more of an institutional grade fund.
And what are you seeing out there? I mean, given that you bring on roughly 100 new funds per year, you probably have a good gauge on economic health, economic activity, the state of the investor, what they're worried about, what they're looking forward to. What have your conversations recently been like?
Yeah, all over the place, right? I mean, look, it's no question the past 18 months has been pretty difficult in regards for fundraising, right? But some of the best and largest funds all started out of downturns, market downturns, right? When there's market downturns, creates opportunities for investors. And in reality, this is just a long game, right? When you're managing money, you're not thinking in terms of weeks or months in most cases, it's years, right? And it's those that really put their head down and go to work are the ones that have been successful, in my opinion, and are just thinking people are always surprised.
Sure, yeah, I mean, I guess short-term increments over a long period of time, you can see significant compounding, I guess, if that works to your point.
Yeah. Yep. Yep. Exactly.
So
Well,
go ahead,
go
sir.
ahead. Well, I was just going to say, like, we always talk about the compound interest, right? And how it's the eighth wonder of the world. And in reality, like compound interest applies to your life as well. And it applies to your experience. And those that go out and actually get in the game and start trading and start participating in the markets or start making investments ultimately win in the long term. There's two core types of emerging managers that I see, right? There's the traditional manager, Ivy League degree, goes and works on Wall Street for 10, 20 years, and then they spin out. They're sick of working for the man and they spin out and start their own shop, right? That's the traditional path to being a fund manager. The untraditional manager, which I think may coordinate with your audience here, is somebody that just starts doing deals, right? They take their own capital and they start either trading, they invest, they purchase a business, they invest in real estate, and guess what? They make money. And so they do it again and again. And now to scale their business, they go and either syndicate deals or they start leveraging other people's money. And by repeating this over the course of several years, it positions you in a spot where you're now in a better spot than most to go out and raise a fund, right? Those traditional managers that I was talking about, those institutional grade managers, they really never manage their own money. And so, from like an alignment of interest, it's a huge vote of confidence from investors to see somebody that has an audited track record of your own performance. Because again, if you're trading at a big shop, a lot of the time they won't let you take that performance with you and leverage that performance as you're starting your own fund. So just start trading your own money, syndicate. You can start an investment clubs. You can start a hedge fund incubator. There's a lot of different products that you can start, but just start trading your own assets and get that audited track record. And nothing else is going to help you grow more than that. So
That's really interesting. Two main takeaways for me. First was the compound interest component, and I always talk to folks about it. It's not just about the money that's compounding. It's the experiences, it's everything you go through, it's the organization, it's the education, right? There's so many factors that go into compound interest outside of money itself. Not to say that compounding dollars isn't a great thing, it's a terrific thing, but maybe we can compound all other aspects of our life into strong growth. And then secondly, another big takeaway was what you said about folks managing their own money, maybe not having that Ivy League exposure early. A lot of times, more established, institutionalized kind of managers, they maybe come from a family that's already integrated in finance. So it's easy to get internships in the big shops, all that kind of stuff. Whereas those folks that are more nitty gritty, that have perhaps a less traditional route, also carry a strong set of skills. In fact, here sometimes at Interactive Brokers, we have these small investors that over 5 years or a decade, they end up running a book that's $5 million, $10 million. All of a sudden, they qualify for a hedge fund marketplace program, right? Especially if they've been a client for a while. And like you said, they have the audited financials, and that really helps them. In terms of some of your customers, what would have been some of the feedback that you've heard from Interactive Brokers? And how do you sometimes recommend us when you're talking to some of the smaller hedge funds?
yeah. Look, I focus on like micro funds. So most of the time, it's somebody managing less than $100 million on their first fund. And guess what? When you're trying to raise $100 million, it might start with just 4 million bucks or 6 million bucks or $12 million, right? It's not a lot of money at the beginning. And I think what emerging managers need to solve for is load cost, right? Like, for example, there was a manager that came into my pipeline. Like I said, I partner and invest with managers, so I underwrite them extensively as they're getting off the ground. And there's this manager that came through that had about 20 million AUM. But he went out and chose the most expensive service providers you could possibly get. And he set up this master feeder fund structure and he had all the bells and whistles. And his load cost was about $1 million a year to run his hedge fund and only managing 20 million. right? So your relative load cost on your dollars, you're 5% in the hole before you even start trading. Like you have a 5% catch up to even break even to start returning money to your investors at that point. And that's not even including your management fees. Tack on the other fees, he was like 7 to 9% in the hole. And I was like, this is terrible. Like, I don't want to work with this group. So, as an emerging manager, you need to solve for load costs. So, why I like interactive brokers is because they have a more amicable fee structure to emerging managers. And so, I always say, look, you don't need the biggest bulge bracket service providers when you're just starting out. It's probably to your detriment unless you're going out and raising a couple $100 million on an institutional fundraise, right? If you have a really large LP base, like they're going to want to see certain logos on your deck. They're going to want to see that you have a certain audit firm. They're going to want to see that you have a certain prime brokerage firm. But in reality, for most emerging fund managers, you're primarily starting off by raising from high net worth individuals and family offices, and maybe if an anchor might come from an institutional grade allocator. And 9 times out of 10, they care more about you solving for load costs than having a big name logo on your fund.
Yeah, no, and that's interesting. Our average hedge fund is around $8 million, but we do have ones that are up to $1 billion. And here at Interactive Brokers, we compete in a bifurcated way. A lot of the bigger broker dealers, they don't accept small accounts. We compete with
Right.
a lot of the retail broker dealers, but we also compete with the institutional broker dealers. And yeah, we're hoping that our logo and all that becomes a lot bigger over time. And one thing with us is we're relatively young. We were established in 1978, where some of those bigger broker dealers have been around for 2 centuries and all that. So it's so we're working on it. Finally, what's some advice that you would give a younger fund manager in any kind of fund, whether it's private equity, hedge funds, real estate, or venture capital?
Yeah, I would say put your investors first at the end of the day, right? Like it's not about you. It's not about you making money, whatever. It's about you making your investors money, right? And as long as you put that first in every decision you make, right? From the risk that you're taking on in different positions to your fee structure to the partners of who you're paying and how you're paying. If you put your investors first at the end of the day, you're going to win in the long term, right? It's inevitable. If you wake up every day and you're thinking about, hey, how can I do good for my investors? You're going to be all right in this industry. And there's a lot of firms out there that start to get too, I don't know, greedy for lack of a better word. As you start to get bigger, you might live lavishly off just your management fee income. And it's a terrible alignment of interest, right? So having strong hurdle rates and complex management fees that tier down as you grow, or returning even excess fee income that's coming in back to your investors. Like if you just put your investors first, you're going to win in the long term, in my opinion.
Mentioned something really interesting. So one thing we've also been viewing is some hedge funds, they get so big and then they decide to turn into family office. Sometimes they send all the existing investor money back, or they let them know that they're only going to manage it for another year, or they keep who they have and they block out new folks from coming in. What are your views on some of the developments there?
Yeah, look, family offices are an interesting beast. Over the past decade, a lot of them are starting to step in and do directs, like they're doing direct deals. And we see that a lot more in like private equity, real estate, venture, where they say, hey, look, I'm sick of allocating to a blind pool fund and letting somebody else choose the investments. I want to have more control. And so we've seen family offices take a lot more approach to direct. Now, within the past 18 months, it's kind of been a reckoning here that I've noticed, a similar theme, if you will, where these family offices that stepped in and wanted to do direct, maybe things aren't going how they planned in the portfolio. Things aren't going as they planned in the company or in the asset. And it is taking a ton of time, right? And so, in a lot of recent conversations I've had with family offices, they've said, look, we tried direct. It was fun. It was good. But we now know there's pros and cons with any investment structure. And so they're taking a step back and saying, look, let's do more passive allocations just because it's a lot of work. It's a lot of work to manage. I mean, any sort of alternative asset manager, you're an active manager at the end of the day in most cases, right? Like you are actively managing those investments. And there's a reason that you charge fees. It's because, I mean, there's a lot of work that needs to be done. And so I think we've seen that shift. In regarding to family offices, these funds turning into family offices, look, I mean, it's a natural consequence. Asset management is an extremely lucrative field, right? And as managers start to accumulate their own massive amounts of wealth, it's no wonder they want to go off and start a family office. And I will say that the best managers, though, at the beginning, I would say the first decade, they always have the majority of their own wealth in their own investments, right? And they never go outside of that. So some of their biggest LPs in their own funds as they grow. And then they'll start to branch out into other investments down the road. But I mean, you really need to have that again, back to alignment of interest with your limited partners. Like you have to have that alignment.
And another interesting thing you mentioned is active investing. Some conversations that I've been having with some of our customers recently has been that the passive indices have really outperformed a lot of active managers because Nvidia's run has been so concentrated where if you had a passive investing style and just the S&P 500 or the Qs, you've been rallying like crazy. But if you're an active manager and you're maybe prudent on your positioning and you don't want to have too much of Nvidia, all of a sudden you end up underperforming. So that's one important development that I've been noticing recently. And also, overall, folks have been saying that active investments aren't worth it. I disagree. I think investments are actually better than passive investments. It's just that we haven't really seen much downside recently or sustained downside. So hedge funds are naturally more cautious. They naturally have hedges on. But like passive investing, there's really no hedging. Your only hedging is really dollar cost averaging, which in theory is not really hedging. You're just buying over time. Any thoughts there?
Yeah. Look, I mean, it's a great point. Like, hedge funds do best in times of high volatility, right? And when there's high market downturns, that's when active managers get to really boast their performance, or even in a flat market, right? It allows them to better capitalize on the market. But look, I think it all changes, right? Just wait a couple years or even a couple months, and the story's going to be different. It's constantly evolving, it's constantly changing. I think there's benefit to both in anyone's portfolio in all reality. Not investment advice for any way, shape, or form, but I think everyone should have passive, long only exposure in the marketplace. And I think an investor wants that. But when you look at portfolio construction, I mean, alternatives serve a very unique value prop to your portfolio, right? Like you've already got your long only exposure. And I mean, hedge funds came out by being a hedged, like it was literally a hedged fund, right? I mean, those are the name derived from is that it's a hedged vehicle. And so it comes back down to like, hey, what is your thesis? What's your investment policy statement? And really, what value are you delivering to an investor's portfolio? And if that's risk mitigation, great. If that's inversely correlated to your long exposure, great. If that's overexposure on doubling down on bull runs, great. Like whatever it is, like I just think that you need to be crystal clear in what your strategy is and know your value prop, know where you're playing. I think too many investors and early fund managers just try and be an everything burger, right? They try and provide. Oh, you want yield? Great. Oh, you want growth? Great. Like you want all these characteristics of an investment? Great. And they almost are just catering. They're honestly subjecting the integrity of their investment thesis just to cater to investor needs or asks or wants. But at the end of the day, I think it's so much better when a manager comes in and knows exactly what he's looking for. Like, I don't pretend to be an expert at all investment strategies, right? In any way, shape, or form. Now, I allocate across alternatives. I allocate to private equity. I allocate to venture. Allocate to hedge funds. But look, I'm not an expert at all of those things in any way, shape, or form. Like I'm an expert on running and starting funds at the infancy stages. But I think the best managers have a extremely high conviction in their investment strategy and have thoroughly thought through the value prop that they are delivering to their LPs, and they're confident about what they know and they're humble about what they don't. And they seek education, they seek guidance, they seek mentorship in those areas where they lack experience and depth. But, at the end of the day, they're the expert investor, right? There's three main roles to a fund that we always talk about. There's your expert investor, somebody that's your CIO, right? They're making the investment decisions. There's your fund manager, think like a COO or a CEO. It's somebody that's running the business, right? If you're running a hedge fund, like it's a business, just like any other if you're starting a startup, right? Like there's accounting needs, there's HR needs, there's infrastructure needs for a hedge fund, and then there's your capital raising department, right? And I think again, the best emerging managers are confident about what they know and they're humble about what they don't, and they aren't afraid to seek help on the areas where they lack expertise. So sorry, that was kind of a long deviant from your question there. I kind of got off course of your original question, but
Yeah, no, we certainly appreciate the insights. Any final thoughts before we wrap up?
look, I guess just advice to emerging managers is just play the long game and just don't think about this over the course of weeks or months, but let your experience compound. Have good performance year over year and prioritize that above anything else. And those that prioritize that, like it's inevitable that you'll be, depending on your goals, but like those are the firms that reach scale and those are the firms that reach mass volume. And so just prioritize that.
Well, thank you very much, Lincoln. Thank you for tuning in to Interactive Brokers IBKR podcast. Please hit the subscribe button and you can follow us on Apple Music, Spotify, YouTube, etc. Thank you. See you next time.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry, or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances, and, as necessary, seek professional advice. Alternative investments can be highly illiquid, are speculative, and may not be suitable for all investors. Investing in alternative investments is only intended for experienced and sophisticated investors who have a high risk tolerance. Investors should carefully review and consider potential risks before investing. Significant risks may include, but are not limited to, the loss of all or a portion of an investment due to leverage, lack of liquidity, volatility of returns, restrictions on transferring of interests in a fund, lower diversification, complex tax structures, reduced regulation and higher fees. Hedge funds are highly speculative, and investors may lose their entire investment.